My biggest business loser for 2022 is Visa and MasterCard and traditional payment rails and the entire ecosystem around it. So I think that this is the year you can put on what probably will be the most profitable spread trade of my lifetime, which is to be short these companies, and that anybody that basically lives off of this 2 or 3% tax, and be long, well thought out Web3 crypto projects that are rebuilding payments infrastructure in a completely decentralized way. Now, that doesn't necessarily mean that what you say won't also happen, both that Stripe will have an incredible IPO and that a lot of these scammy crypto projects will go to zero. However, if you read the white papers of these crypto projects and you systematically put together a framework, I think you can be long those and you can be short Visa, MasterCard, because I think this is their peak market cap. Okay, look, the week before when I started to trim, it was like, oh, how dare you, blah, blah, blah. And I'm like, well, I don't know if the smartest people are selling. Maybe it makes sense to sell. So I started to trim, and I'm so glad that I did, because it was, 10 days ahead or a week ahead of all of this craziness. Now look at what's happening in the markets today. People are going massively risk off. There are almost 500 stocks that are off 30 or 40% in the last 30 days. The stock market is still basically at all-time highs. So think of that for a second. So everybody that thinks that the stock market is doing poorly is wrong. It is doing exceptionally well. Elon Musk sold, 10 billion. I've sold almost, I think, $600 or $700 million worth of stuff this year. This is what I think smart market participants do. You don't just wait and just try to market the last tick. Everybody that thinks that the stock market is doing poorly is wrong. It is doing exceptionally well. It's just that the 400 stocks that people in Silicon Valley really care about have been getting kicked in the teeth.
Yeah.
And the paper company and the specialty chemicals company have actually done reasonably well, which is nothing that any of us have exposure to, or some of us don't have exposure to. So go ahead, Jason.
Chamath, can we then look at this as, hey, the era of we're going to give a lot of credit to companies for, what's going to happen in the next 10 years.
10-year outcomes, yeah.
The 10-year outcome that we saw, Rivian came up, and then many other stocks, and obviously crypto falls into this. This idea of giving people a decade of forward-looking credit maybe is going to come back to,
I think it's too early.
Let's weigh these and look at earnings, or maybe 2 years of credit.
No, I'm not going to say that, because I think it's too early for us to sort of go and jump to these conclusions. Right now, we are in a moment. There have been 71 or 2 of these moments since 2009, where you have either a sector drawdown or a market drawdown. In this case, we're in the middle of a massive growth sector drawdown, okay? The multiples on these companies are shrinking. Companies like Snowflake and
Peloton.
Cloudflare,
Zoom.
We're trading at 70 to 100 times revenue, and people are reevaluating whether those multiples are worth it, irrespective of the quality of the company, because those are very high quality companies. So we're just re-rating the risk right now, okay? And it's not broad-based. The real problem is all these companies that I think raised a lot of money in private markets are now going to get stuck, because if the public markets have compressed multiples by 30 to 50%, they are the ultimate buyer. The idea that you can wait and then go public later may not stand to reason, especially if inflation really keeps these multiples in check. We had this happen in 2018 because in 2018, it looked like there was going to be inflation. Powell, basically killed the market. He raised rates. And then it turned out he was completely wrong, and China was okay and everything was fine. And then the market just completely violently snapped back. Again, this is what I'm saying, which is it's too early to tell whether this is just a short-term opportunity for people who have made a lot of money to de-risk. And again, Satya Nadella just sold $300 million of stock.
Elon has sold half his position? It was half of his position. Yeah, I mean, that to me was significant.
Elon Musk sold, $10 billion. I've sold almost, I think, $600 or $700 million worth of stuff this year. This is what I think smart market participants do. You don't just wait and just try to market the last tick. We focus on it a lot, but when we talk about the core structural economy, the stock market is a lagging indicator of a whole bunch of things. Sometimes it's cash flow. A lot of the times it's emotion.
money supply.
Money supply. I think that there's a much more important thing which we've talked about, which is that, we have said, and I have said, that coming out of the pandemic, we are moving the world back into a more, decentralized place, right? The centralization was this just-in-time, single supply chain, single point of failure existence. Today, for all of these small businesses to sit on top of Visa, MasterCard, and Amex rails, it's unnecessary. And so it'll probably get developed in the developing world first. This is why I think, focusing in markets like Nigeria, to me, are way more exciting than talking about these fading Western European countries. Who cares?
Right.
This is where this stuff will happen. It's not to say that those other companies can't, trundle along for a while. But when I say, we'll look back in 10 years and their market caps will be materially lower, anybody in those traditional infrastructure and rails versus anybody in this new infrastructure and rails it will look like a no-brainer, your existence. And if you look inside of China, the thing that they want more than anything else is to become even more centralized, right? I don't know if you saw today, but there was an article in the Wall Street Journal about how China is going to create basically an overall holding company to own all the rare earths that are made inside of China and then to apportion them out as they see fit. So the government will now control a critical element and supply chain into climate change. Okay.
So basically, they're creating their own OPEC in a way, like their own version of.
It's a very good way of saying it. Exactly. So So China is pushing more and more for centralization. So for example, myself and Fortress, we did this deal a year ago to bring this company public called MP Materials, and the whole idea was to start to build diversity in the supply chain, to build a decentralized supply of all kinds of things. In that case, it was around these rare earths because we saw this thing happening in China, okay? The problem is those kinds of investments are very much few and far between. So the solution to fixing the core structural inflation we have is going to take a decade. It's going to take trillions of dollars of investment. And more than that, I think it's going to take an enormous amount of coordination between private and public participants. And I think that that's where this whole thing fails, which is why, I'm a little bit more concerned about it. And I think I've explained this to you, but look, we have massively underinvested in the level of infrastructure we need to support ourselves.
Yeah, we outsourced it.
As in a simple example, starting in 2016, we absolutely decapitated the ability for the United States to invest in our own true energy independence. Okay? The level of fracking, the level of nat gas, oil, all of this stuff basically fell off of a cliff. And you would say, well, that was the right capital allocation decision because of climate change. Well, it turns out today, not really, because we have absolutely no investments on the climate change side.
Right.
We don't have rare earths. We don't have lithium. We don't have nickel. We don't have cobalt. We don't have graphite. So we actually can't make the batteries, which means that now oil is at $100 a barrel and gas costs $10 at the pump. So that was a coordination problem. Really, the right thing to have done would have been to continue to invest in our domestic supply chain for energy, while we also created incentives to decarbonize. So this is what I mean by these issues have been building up for years, Jason.
Yeah, decades. Yeah.
Inflation is now here. I think it's here to last. I've been pretty consistent about this. And this is the real reason why we're going to have a few years of pain. And so money-losing, unprofitable businesses selling future cash flows in 10 to 12 years, some people will buy them, but I won't be. Entry phrase that says adversity makes for strange bedfellows. And I think what happens when you are in the middle of enormous adversity, you need to do whatever it takes to win, right? That's, I think, why Zelensky is so patriotic and viewed so heroically around the world now. He's trying to defend his country and his people. I want to take the counter of, David, what you said. I actually think we are at war, but it's the most positive form of it in the sense that we are learning a different kind of warfare. Now, if you think about how we used to fight up until basically the Persian Gulf War, it was armaments and tanks. And then that evolved in the Middle East because we had to fight insurgents and, urban terrorism in many ways, right? I think this is a way in which we are learning that there's a different kind of warfare as well, which is fundamentally economic. And so, it may not take the same shape as drones and missiles and fire and guns and bullets, but I think you would be foolish to make the mistake that we are now not at economic war with Russia. And at the end of the day, the outcome is the same, which is either they survive or they don't survive. And everything we've done points to that we are willing to fight, and we are willing to put a lot of economic collateral and chips on the field in order to win this battle. So I think in that respect, we are kind of at a war.
Is this a nuclear level economic decoupling?
This is my point, is like everybody has a historical framework where they want to go back to how the natural path of escalation works. And I think this is a very different form of escalation that we need to consider. And I think that this is the kind of warfare that may actually, be the way in which wars are fought in the future. You seize assets, you shut off access to supply routes, you make it impossible for anything to work. So, I'll give you a simple example. A form of warfare is what's happening right now in the sense that, for example, the Russian skies are completely clear. Not just because that, no external airlines will necessarily fly there, but because Boeing and Rolls-Royce and GE and Airbus basically pulled all of their support, all of their parts, right? We've gone to war with respect to their petroleum and LNG supplies. How? Not necessarily because we won't still stop payments, which we are still enabling, but because the actual refiners won't take the oil and the LNG, because they then would be subject to sanctions. The people who would ship that are no longer taking those payments or those barrels of oil into the marketplace because they can't get insured by international banks. So in all of these various ways, we are actually at war. And I think, maybe this is the way war should be fought in the future because it'll save thousands of lives in the more classic way of describing how lives are sacrificed for war. In times of uncertainty, you actually want to be deploying. So, I announced, what was it, last week, I think it was?
The solar deal?
The solar deal, I put $228 million into this thing. And then I did another deal. I put $45 million into this thing you guys know about, which we haven't announced yet.
Yep.
So, but other than that, I've been literally white-knuckled. I don't like to open the stock app. There's no point.
Take some Dramamine before you open your Morgan Stanley account.
The stock app. And what's so funny is like my Bloomberg terminal, which is right beside me here at my desk, I have not logged into it.
Oh, God. Put it in a drawer. Unplug it.
Yeah. There's just no point. At the end of every week, I get a report, right? Kind of like our P&L. And I just look at the top line, like Connor always sends me the top line is like, and the last like 8 weeks in a row, we've lost 1%, we've lost 2%, we've lost 3%. The time that it was
Sachs
like
wishes he lost 1%.
3%. I celebrated. I got so drunk that night. I was like, finally. I sent you guys this tweet from Morgan Housel, who is a great guy. And he has this fabulous tweet. He says, it says the shock cycle. And it's this beautiful cycle. Assume good news is permanent, oblivious to bad news. Then you ignore the bad news. Then you deny the bad news. Then you panic at the bad news. But then you accept the bad news. And then you ignore the good news. You deny the good news. You accept the good news. And then you assume the good news is permanent. That starts the cycle. If I could just put it out there, I don't know today if you guys saw non-farm payrolls, but we had a huge print in unemployment, like really great print, meaning like a lot of employers were able to find people to take jobs. It was a big number. Who is a great guy. And he has this fabulous tweet. He says, it says the shock cycle. And it's this beautiful cycle. Assume good news is permanent, oblivious to bad news. Then you ignore the bad news. Then you deny the bad news. Then you panic at the bad news. But then you accept the bad news. And then you ignore the good news. You deny the good news. You accept the good news. And then you assume the good news is permanent. That starts the cycle. If I could just put it out there, I don't know today if you guys saw non-farm payrolls, but we had a huge print in unemployment, like really great print, meaning like a lot of employers were able to find people to take jobs. It was a big number. This week was really important because we had two huge buckets of uncertainty taken out of the market. So the one we've already talked about, which is when the market saw that there was a surface area of a deal between Ukraine and Russia that was really constructive, because neither side would have signaled something if both parties were very far apart. So that meant to the markets, we're a few weeks out from something getting done. And then the second thing was Jerome Powell and the Federal Reserve. They finally had their meeting. They raised rates 25 basis points, but even more importantly, they gave you a very prescriptive forecast of what the next year will look like at a minimum, and possibly even 2 years. And once you could have that, you were able to then go and redo all of your expectations. And what people realized was, okay, inflation may actually start to get tamed in the back half of the year. The economy is still quite strong. And we could actually support 2.5% interest rates and still actually grow really well. And so what you've seen in the last 3 or 4 days is a reaction to the loss of uncertainty. And so there really isn't, the only thing, the fly in the ointment could be if the war all of a sudden escalates. Not that it gets dragged on, because at that point that's also, I think, been priced in. But if something very meaningfully different and Russia in this case ratchets up the intensity. But in the absence of these things, you basically have really constructive dynamics right now for at least the next month and a half, maybe even 2 months. Look, the thing to remember, and I hate to be this blunt, but it's true. Retail is not a very good signal of anything. In fact, if you actually look at retail flows, typically you will make money by doing the exact opposite of what retail does. Every single day since the beginning of this year, retail was a net buyer. In all of those days, the market got punched in the face. Finally, at the beginning of March, retail capitulated, right? And I posted that same day and I said, guys, this is the moment to buy. And lo and behold, what happened? The markets rallied meaningfully from that point. And the reason is because they were going into the end of Q1. You have a huge tax bill due in April 15th. People were starting to just finally give up. They were buying every single day and they finally gave up. But that capitulation was the moment that you buy. So if anything, retail is the, I've said before, you fade your fade list. Retail flows are something you typically will make money by fading, by doing the exact opposite of whatever retail is doing. And you just need to have access to that information. If you have access to it, you can kind of, profit from it. So where are we going from here? Probably up.
Risk is actually for a recession. We talked about this before. By the way, just to your point, you're right that we pumped in $10 trillion, but over the last 3 weeks, and really over the last 2.5 months, we have actually eviscerated $10 trillion of value as well. So if you want to measure it, we put 10 trillion of excess capital in, but we've now destroyed $10 trillion of equity.
Destroyed it by lowering the prices or repricing stuff. Yeah, we've repriced
equity,
everything.
Crypto in the last couple of days has just been shellacked. Growth stocks have been shellacked. Biotech stocks have been just absolutely smoked. Everything is getting crushed.
COVID stocks.
But David is saying something really important. The risk, in my opinion, is not runaway inflation anymore. And the reason was what happened this weekend was incredibly important. And we have seen this happen just a few years ago. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with this issue of whether we should raise rates and by how much, because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating, right? You need to incentivize businesses to spend by lowering.
By turned over, you mean it's slowed down. People are not building, companies not doing new projects. So you want to give them an incentive or maybe some catalyst to start some new company or start some new project because all their real estate projects have wound down.
In 2018, here's exactly what happened. The setup was everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over. And we realized that their economy was not nearly as strong as we thought it would be. And so our reaction was disproportionate to what the actual data on the ground said. We entered a recession in 2019. That's when you guys probably saw Trump going crazy, blaming Powell. I mean, most of us ignored it because, we were all dealing with, Trump derangement syndrome. But the underlying thing of what he was saying was, hey, hold on a second. You just caused a recession in America by raising too quickly. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates, on Wednesday, I think, of this coming week. What is he supposed to do? Bill Ackman 2 weeks ago was advocating for a 50 basis point raise in this meeting. So that's way beyond what people even thought is supposed to happen.
We should just remember that Bill Ackman has bets, macroeconomic bets in the market. If he's calling for a 50-point raise, I guarantee you,
he's going to make a lot of money.
You'll make a lot of money if there's a 50-point raise.
No conflict.
I really don't like this culture that's emerged via Twitter mostly, where you all of a sudden have to be this maximalist that basically falls on their sword and never sells in order to be legitimate. And I think that that's a really dangerous place to be. So, look, if I take a
Why is that dangerous? Yeah.
Well, if I take a much, much bigger step back, let me put Solana in the context of crypto, and let me put crypto in the context of the markets and where we are today at the end of the week after, Q3 earnings in November of 2021. We have the stock market at absolute all-time highs.
Ripping.
We have crypto at absolute all-time highs.
Ripping.
We have the art markets. I don't know if you guys saw Phillips and Christie's and Sotheby's this past week at absolute all-time highs.
Sold another Beeple for $25 million.
We have inflation at a 30-year high. We have 10-year break-evens at a 25-year high. We have, $1 point some odd trillion that we just approved last week, and we're still horse trading on another $1.8 trillion of stimulus that we're going to put in. And so then you have, I think the most important thing, which is the two most important founders of our generation, the two smartest people who have really consistently won, Elon Musk and Jeff Bezos, have collectively sold more than $11 billion of their holdings this year alone. And if you can't take all of that and decide for yourself what's right for you and your family, you're doing yourself a disservice. I think it's important for me to never sort of be forced to tell folks whether I'm buying or selling, although I'm willing to do it in moments where I think it's important. But I think it's really important to understand the context. And so I think these folks that think derisively about individuals who are managing risk, I think it's really naive. And I think it creates a lot of missed opportunity for them as well. If the smartest people in the world are now selling their core holdings that they told you they would never sell, and you are not reconsidering your position on things, you're either much smarter than them or you're being really, really reckless. But what's so funny is half the people on Twitter spend all their time in crypto land saying things like, never gonna make it, have fun staying poor. They're extremely, Jason, as you said, tribal. I'm not sure that they're doing first principles analysis of these things.
They're toxic.
They've gotten exceptionally lucky.
Yeah.
Some of them are exceptionally good, but many people, broadly speaking, have gotten exceptionally lucky. And I think a little bit of it is getting to their head where they become, very virulent against people that they think, whose perspectives may actually be negatively affecting their position without actually understanding what David said, which is these are incredibly deep liquid markets, and one person's opinion can't do much of anything. A lot of the stuff that we've done, DSO, is purely driven by developer interest. When we see developers in the open source ecosystem building things on top of this stuff, making stuff that's composable and usable by other people and building infrastructure, we don't really second guess that because they are spending the most important currency, which is not monetary capital, but human capital.
Yeah, their time, their skill.
Their time and their skill and their reputation.
They can apply to another project, yeah.
And so when enough developers, so I've always thought you just follow the developers, and as more and more projects get started, you just have to unemotionally support that. I think the writing is on the wall, which is Bitcoin is gold, Ethereum looks like it's trending to be silver, and Solana could be the first, but there will be others that come after it, of real developer ecosystems that can be built on top of it. The other thing that I would offer up to people for them to think about is before you blindly go and rush into crypto, one way in which I try to think about these things is in the following way. You see these projects get started all the time, and I would view each of these projects as a mini economy and really try to think, what is the economic value of what's happening under the hood? So simple example, Helium is an interesting project that's trying to build a completely decentralized 5G infrastructure, right? Render is a really interesting project that's trying to build a completely decentralized, graphical processing infrastructure, right? GPUs essentially. In both of those things, you can quantifiably, economically measure what the value is that people get, right? In the case of Render, you're basically displacing an AWS instance. And so that has a price and a value. And so, for Render to be valuable, there's an economic value that it replaces. If you're joining a hotspot, that has an economic value where you necessarily have to pay, to get internet connectivity. If you all of a sudden are on the Helium network, that displaces a measurable economic quantum. Understanding that is probably, and taking the absolute value of that, is the best way of really understanding which projects have potential. So if you take those two ideas and marry them together, where is their developer interest and where is their measurable economic activity? At the intersection of those, I think, are the really compelling projects that can win. The Fed has to decide what to do in the face of incomplete data. It's not as if we've even stopped all of the purchasing of assets that we've been doing. We're still putting money into the system. I just want to be clear. We were debating when we stop the spigot. We're not even debating when we shrink our balance sheet as a country. So we are in a really complicated moment. And I think the risk is that there is an overreaction to incomplete data, and we plunge the US economy into a recession. And I just think that has to be really thoughtfully measured. And we've seen this in 2018-19. I think we're in the 8th inning of the tech drawdown. So if you're a high growth tech company, you've been smashed for 3 months in a row. And the reason I think it's persistent is that there's all of these things are intertwined. And so, if you want to just bear with me for a second, like let's just go to the entry-level economic job, right? So you're a barista at Starbucks or you work at McDonald's and you're making $17 to $20 an hour. What that does is it shifts labor. And eventually there are other people that are entering the workforce or, may shift jobs. And essentially it just causes this leaky bucket effect where everybody else has to then accommodate itself. So, you have a guy like, you have a company like Amazon, which is now going to pay $25 or $30 to keep folks, right? Because otherwise they may say, if I make $15 or $16 an hour, I'd rather work at McDonald's. It's simpler.
And free college.
It's not backbreaking work, blah, blah, blah. So then they start to increase the amount that they pay. They increase their benefits and the like. I saw this thing this week. There's a crazy thing that's happening though, which is it's now pulling people from non-traditional job classes into those jobs. There are teachers that are leaving teaching to go work at an Amazon warehouse. There are firefighters that are quitting being a firefighter to go work at an Amazon warehouse because you make the same or more, plus you have all of these other benefits, and the job is structurally a lot easier. And so people are making different optimizations. And to that point, I think we talked about this, and Nick, you can put it in the group chat. In Reddit, as an example, there is more engagement in the subreddit around having a simple work life than there is now in Wall Street bets, right? So there's been a structural cultural change where people need to get paid more to do the same amount of work. And then at the same time, you have all of the supply side getting more expensive. Fertilizer makes corn more expensive. Lumber makes house prices more expensive. Chip prices makes the iPhone and cars more expensive or completely backlogged. Yesterday at Poker, Sunny was showing us he bought a Tesla, and the delivery period is October of 2022.
Yeah,
it's freaking crazy. So I think that this is the beginning of a persistent cycle.
I think
in 1980 we changed the goalposts for CPI. So even as a measurement to know what we look at, and I think Jack Dorsey tweeted this out. So Nick, you may be able to find this tweet, but we changed the measurement of how CPI measures. And so if you go back to the original measurement, it looks like inflation in CPI is much more pernicious than we would otherwise think of if we just look at the new CPI that we that we started to look at as of 1980. So that's another sort of like point.
We did the same thing with.
I just go back to what I said early on.
Who had given up looking
The
for
two
jobs.
smartest people that we both know are net sellers.
Well, they're selling some, yeah. I mean, they're not selling everything.
I'm just saying the two smartest people we know.